Created with free version for non-commercial use.
Welcome guys and girls to episode 3 part 2. So now we're going to transition into more of the entry types so you can really understand everything that you've now learned in part 1, the nature, evolving with the structure, and you really understand how we're looking at the markets. This is where we dive even deeper and we go into more of how do we enter these positions so we can fully understand how to capitalize on these moves. Get ready for part 2. So welcome to part 2. In episode 3, guys and girls, this is where we build on part 1. And as we lead on from evolving with the market, let's take a look at entry types and dig into what that means. So with entry types, it's really important to understand what we kind of focus on here. So as an entry type, it refers to how you decide to enter a position in the market. Once you've outlined a potential position of point of entry, as a Falcon student, you'll have two options. This decision is entering as a risk entry or a reduced risk entry. Now, there are two entry options when entering a trade. As a general rule of thumb, risk entries come at more of a risk to a potential loss, but in offer they offer a bigger reward. And when it comes to a reduced risk entries are essentially, they allow you to wait for further confirmation of a trade direction before you enter the trade. It allows you to enter with confirmation at the sacrifice of some risk to reward potential. So for example, you could be looking at a continuation pattern, looking at a bear flag, and you could be looking at, let's say, taking a slightly larger stop with the reduced risk entry, which would naturally reduce your risk to reward, or you could get in with the risk entry within the pattern. Essentially, risk entry doesn't mean that it's riskier, it just means nothing is confirmed yet because you're trading within a particular pattern, where reduced risk is more, right, we've confirmed, slight less risk to reward. As you progress through the Foundation Series course and within Falcon as a whole, you'll soon realize that risk entries generally aren't as risky as what I just said. You will develop the skill set and understanding of the market that allows you to capitalize on massive risk to reward trades. So entry types. Following reduced risk entries and risk entries, I'd like to show you a few different variations of entry types that you'll find across the market, building on your ability to forecast price development in the markets and spotting these reoccurring formations. The first to touch on is the arc. The arc is the evolution of the double top pattern, and it can be learned about in more detail in Quick Tips Season 2, Episode 3. It is a risk entry position that we utilize and often look at this within the Falcon strategy. The second is the hover. This is a reduced risk entry that trickles along the edge of a trend line before breaking either to the upside or to the downside. These trades present us with highly probable entry points to get into the position, and we can remove the risk fairly quickly. The third to mention is the 1 hour retrace candle. This is broken down in more detail in Quick Tips Season 2, Episode 2, and is one of the most probable and precise ways that you can enter with a risk entry position. It confirms the reversal to either to the upside or to the downside by fully retracing of the previous candle. These are all covered in more detail in both Quick Tips series and the recurring weekly content within Falcon. However, I want to show you a few examples on the charts that you can reference when you progress further into the content. So let's take a look at that now. Right, guys and girls, so now let's move on to entry types. Now, it's important firstly for you to understand what are the two entry types we focus on. So we're going to go over multiple ones of those. First up, we're on CAD Yen. Let me explain what they are first. So essentially, we have two types. We have risk entry and reduced risk entry. So first up, let's take a look at a pattern so we can identify what would a risk entry look like and what would a reduced risk entry look like, because that's really all you need to know. There will be different variations, but understand this: risk entry doesn't mean more risk. We still risk 1% per trade. All it means is what I'm going to show you right now. So let's take a look. So let's say we've got an ascending channel, which you've learned in this episode, and we look at price moving up. So we've got an ascending channel. Then it wouldn't be unusual at the top for us to be looking for sell opportunities, right? So if we're looking for a sell setup at the top, a risk entry is essentially you taking the trade before we've had the commitment. So we're being ambitious in the sense that the pattern hasn't broken out yet. So we'd be taking it at the top, expecting for a sell. A reduced risk would essentially be us taking the sell on the break of the pattern. So let's say, for example, we get the tool and we're looking for a sell setup. In this situation, let's just call it, we'll have a 50 pip stop. And we're looking for this to the downside. We're on the daily chart here. Let's say, for example, we're looking for 7.7 to the risk to reward. So we're looking at about nearly 8%. And we were potentially looking for this to break to go all the way to the low for around 20%. That's the risk entry at the top. If you was to take this, of course, on the break of the pattern, and of course this is to scale, as you can see, you'd be taking it based off of the actual break of the structure. Now, generally speaking, we don't take large patterns like this with our entry just below here and our stop above here, because you will see huge stop losses. Not something as big as this, but again, we'll be looking at 100, 200 pips. We don't need that. We're looking for precision. So I'll show you where it's more relevant to take a reduced risk entry, and that's more so to do on flags, and then where we look for more risk entries. So let's say, for example, how could we take a reduced risk entry within the ascending channel? Is there potential to do that? Yes. So let's say, for example, we've got price moving up like so, and what we have a lot is patterns within patterns, and what we see is we'll see a smaller version of that. So essentially, you imagine we've now got an ascending channel within this pattern. We're still looking for sell setups. We'll have a trend line on like so. As you can see, it's just a smaller degree of this bigger structure. Rather than taking it on the break of here, we take it on the break of here. Why would we do that as a reduced risk entry? Because essentially all reduced risk is that it's now confirmed. So we're taking it based off of the breakout of the structure, rather than taking it on the inside of the pattern where we haven't committed yet. Now, what are the benefits? What are the downfalls of both? Well, essentially, if you're taking it on a reduced risk, the market has more likely to commit to itself because it's broken out of the pattern. But you need a slightly larger stop loss. If you take on the risk entry, we're timing it more precisely in the sense that we're looking at a slightly better risk to reward. So let's say we've got a 60 pip stop loss. We're looking here for about 6.5. As you can see, there's the risk to reward. If I then took that on the break of a reduced risk and I had it above the highs, we're now at 3.3. So we're doubling our risk to reward in this situation by being more ambitious and looking for this with a risk entry. So essentially, reduced risk, taking it on the break of a structure, so you set your order for this to trigger you in, and with a risk entry you're getting in right at the top of a pattern, still anticipating this to drop. And it doesn't mean that it's really risky, but you have to understand that you could take the trade there, it could tag you in and then form a larger structure. So you're more likely in that type of scenario with an ascending channel, which is a bit trickier, to take a loss. But you have to understand on the flip side, the risk to reward is huge. Now, we don't get too caught up into trying to call the tops and call the bottoms, because I'm going to show you that on various trades as we have multiple entries on the way down. But this is just to give you an example of what that looks like. So that's that on an ascending channel. Now let's take a look at it on a flag, which is where we would utilize it mostly. So let's say we take a typical bear flag. So we've got an impulse down and we're looking for a correction. If we're looking for, let's say, a tight flag, as we know has a high probability, then we'd be looking for a correction like this. When we're getting involved in a trade like this, if it's a tight flag, it's highly unlikely that you'll get the risk entry, because you'll be anticipating the break of this, like so, and then we'll be looking for the downside. Impulse, correction, downside. Reduce risk, simply setting it on the order, on the break of your lower trend line of the pattern, and having your stop just above the high of the correction. These are really, really simple. Where would risk entry come in? Risk entry, this is where we can become a bit more precise, and you'll see them more so on the bigger flags. So same principles, impulse down, and we may have had let's say a tight flag, we've taken a reduced risk, that's pushed down, then we start to get a larger flag. So we pull back, come back down, now we've got a second bottom, and now this is where we're looking at a risk entry. So we have our bottom trend line, we can identify that. It's just a larger version of what we've seen here, right? Then we've got the mini double top within the pattern. This would be us taking a risk entry like so. Why? Because this pattern isn't confirmed yet, and we could break down, go back up again, and form a larger correction. But we're anticipating that this is more than enough. We're looking at the multi-time frame analysis. We've had our first correction here, we've pushed down, then we've got our double top, which is taking the risk entry. So you're taking it inside the pattern essentially. And what does that do for our risk to reward? Well, let's say we're getting in here with a relevant 40 pip stop loss to the low, 4%, 4.6, and then we're looking for, of course, a larger degree. Now, you imagine you take that on the reduced risk entry, you're taking it on the break of the pattern, stop loss is slightly larger, so risk to reward is nowhere near the same. But can you see why it's more relevant to take a risk entry inside of this structure, because you can see the bigger picture, but taking this here makes no sense to take a risk entry because you'll get caught up into very, very small parts of the structure, where it's much safer in this situation to see that, right, it's a very, very tight flag, it's consolidating. When this commits to itself, I'll put an entry there, and that's likely would have committed to the actual trade. Where in this sense, let's say you did take it, because it doesn't mean that you can't, and there will be relevant times where taking on the break of a bigger structure isn't always, 250 pips. Sometimes it will be 60 or 70, so the risk reward still may be there, but you have to stand, you're more likely on a bigger structure to be tagged in here and maybe go back up for the third touch. So you see, then we will develop something at a slightly larger degree with more of an expanding fill, but then you can get the risk entry again. So can you see how now it's much safer to take a reduced risk on the break of a tight flag, and then a risk entry on a slightly larger flag. So it's knowing when to utilize them in that sense. So very simple. And again, we're going to show you some examples now on CAD yen. So let's begin with this on the daily chart. So here we have CAD yen. So CAD yen here on the daily chart, I want to bring your eyes to this structure here. So this is a trade that we took recently. So as you can see, looking at the double top formation, wouldn't it be unusual for us to be looking for a sell? Now, as we look for the sell, you can see that we squeeze correctively all the way up there, and we're creating that ascending channel. What types of entries could we look at here? Well, let's go to the 1 hour where we look at them. Now, remembering again that you can utilize the 15 minutes, but I wouldn't recommend it for a complete beginner. We have a full episode in Quick Tips Season 3 for you to learn all about how we filter and use the 15-minute, but the 1 hour structure is more than enough at the beginning, and then you can tweak it after. But let's take a look at the structure. So as we look at this overall channel, we have our ascending structure, and we're looking for downside. So we have two types of entries here. First entry, we have our risk entry, which we can see here. This is slightly on more of a slightly advanced stage, and I'll explain why. If you're a beginner looking at something like this, I'm going to delete the ray line now just to make it cleaner, but just so you know, this was just a reference point to acknowledge that we've just broken the double top. But let's actually ignore that so we can just focus on the pattern at this stage. So we've broken that double top. Now we look at the structure, we're expecting more downside, and our targets will be here and to the downside here. Now, when we look at this structure, a risk entry would be, like I explained, 1, 2, 3, looking at taking it right at the edge. So this was 100% on the cards for us, and we were looking for a sell right at the top here. So this is how you would take the risk entry. You'd be taking it like this. Your entry at the top, as you can see, you can get a much tighter risk to reward that's relevant to the structure, and you'd be targeting down here. Now, sometimes it won't get all the way to the outer structure because we already broke that double top, so we could drop at any point. But what we do have is 1, 2, 3. We actually have a risk entry in here. So you're essentially taking this trade. Let's replay that back. You're taking the trade here, and it has an element of a reduced risk in it, in a sense that you're either taking it literally right at the top, or you're actually setting an order on the break, like so, like this, So you've got slight two ways to take it, or you're literally getting in right with the risk entry right at the top with about a 15 pip stop, like so, and then targeting the low. Or you're taking it, as you can see, on the break, which is slightly larger, and then as we drop like so, then we play out. So you can see how there are a few ways to take that, 1, 2, 3, but this is slightly on the riskier side, as you can be tagged in, tagged out, etc. What would be the best way to approach this as a beginner or learning the strategy for the first time? Well, I would be acknowledging more so something like this. So let's just take this price back. So you see how we've got our 1, 2, 3. We're acknowledging that we could get a risk entry at the top. What would be a reduced risk entry? Well, reduced risk, remember, is taking it on the break of the flag. So what do we have here? We have our push down. Let's say we ignore that entry as it's slightly more advanced once you understand the strategy. Because you was waiting for this, we get the push down. What do we have here? We have our 6 to 8 hours type flag, our first flag that we look at. And how would we take it from what you've just learnt? We would take it on the break like this with our stop just above. And then we're looking for a risk to reward as our first solid target for about 5%. Now, when we're taking channels like this, it only has to fill 90% of the move, which is why you can see we didn't get all the way to the low, which you would have managed this, and you'll learn more about the management tool to secure the profit. But at this stage, you can see how you're just taking it on the break. Once we've got an identified second bottom, as you can see, if we zoom in here, we have impulse down, correction, continuation. Reduce risk entry, you're setting it just a couple of pips below as an order to trigger you in with your stop just above here. If it pushes, if it tags you in and tags you out, it's likely creating a different structure. You're capped at your loss at 1%. You know, you take it as it comes. There's losses are part of the game. But if you're taking this, as you can see, you put your entry order, whether you're working, you don't have to be by the screen constantly. You're tagged into the trade's committed to itself. And you probably walk away with a good 4% profit on this particular trade, but you'll learn more about that in the management section. But as you can see, very simple. And to avoid getting in that mindset of constantly trying to call the tops and the bottoms of trades, if you've kind of come from different styles where you constantly feel like you're struggling with reversals, you can literally wait for something what we call the first flag. So what does that mean? Well, just going back briefly to the double top, let's say at this stage, it wouldn't be unusual for people to trying to be calling this top here. So rather than trying to call it here, or just really trying to get in, you wait for the first impulse, the first flag. Why? Because the market's now given you permission to take the trade. Because now we've got, as you can see, we've got our first impulse, our first flag. You're setting the order on the break, and you're getting impulse down. Really simple with your entry point. So as you can see, reduced risk entry are the cleanest. The first flag at the top of the structure has the highest probability of playing out. The first flag at the bottom of the structure for a buy setup has the highest probability of playing out. So when we're looking at something like this with a larger double top, we really want to be on the ball because we know this is our go-to. It's at the top of the structure, it's just broken above, catching people on the wrong side of the market that will be trading more of a resistance style game, that we've broken out of resistance to go long. We're expecting this to come back down. Why? Because again, the nature of the market, the pattern, and then we move on to the entry type, which is either the risk entry, as I showed you first, which is the slightly more advanced one, and then the real simple one. These are your go-tos, where you've got the impulse down, the first flag, and then you can take it within there with the risk entry, but again, you want to be a little bit more advanced until we get to that stage. But to keep it simple, that is highly profitable, reduce risk entry on the first flag. This is actually how I took the trade on the break of the flag. Highly profitable, and we really love these entries, and you're going to want these in your trading plan. So that is a combination there, and I wanted to, rather than just show you the flag, build a picture so you can understand the thought process as to why we're actually doing it. So go and see those on the charts, and you'll see many of them, but it's not about just finding flags, because you can find flags in the middle of nowhere. There has to be structure combined with it, and you'll learn that on a weekly basis with the mentoring and just being involved in the community and having help. So that will come naturally over time. So that's CAD Yen. Let's take a look at a few other examples. So now moving on to USD CAD, let's take another look at a reduced risk entry so you can see how impulsive sometimes they can be. So here we have USD CAD, and we've been looking for a sell for a while on this, and we've suddenly got a bit of commitment in this structure here, expecting this impulsive leg to the downside. So as you can see from the top, we break to the downside. Let's go a little bit lower to the 1 hour chart. So if we go to the 1 hour chart and we take a look at this impulsive leg, after we broke out of this corrective structure, and again reiterating the fact that you don't need to be too caught up into trying to call the tops, wait for the first commitment. So as you can see, we get our first solid impulse to the downside, as you can see here. So impulse, and what do we get? We get our tight flag. So if we zoom in on this like so, let's get our angle right. So this has got a slight degree to it, but quite simply it's your tight flag, it's your first flag. And remember what I said at the top and the bottom of the structure, so this being the top of the structure, your first correction has the highest probability of playing out. So the first flag, which is where you want to really be on the ball with. So let's say, for example, you're taking this on the break, you're looking at around a 20 pip stop. Where would you be targeting? Well, first up, you'd be targeting on the higher time frame. Let's take a look, this trend line here. Why? Because you've got 1, 2, 3. But also looking at the overall structure that we could identify here with the low, it wouldn't be unusual to start to create the bigger correction here. And we can see we actually created the bigger flag before the next push down. So that could be a good place if you're not going to hold through the deeper pullbacks. Everybody has their own kind of personality, which you'll develop over time within Falcon, in the sense of whether you like to take profits a little bit sooner. But again, just targeting here, 90% of this already been filled. So let's look at this at around a 14-1. Even on the more conservative of where you probably would have got out with is more around the 10% mark. So let's say real nice 10%, reduced risk entry. Didn't have to get in with a risk entry. You just took it on the break of the flag. And as you can see, again, just 6 to 8 1-hour candles is all you need. And if we zoom in there, quite simply, you can see that really clearly. So what do we have? You can see a very clear structure. Just taking that on the break is the reduced risk entry. So remembering, taking it as a reduced risk is setting your order on the break, anticipating that you break into the trade and then it commits, and then you have your stop just above. Now, you don't always have to have the tightest stop loss. That's not the game. Really and truly, at the beginning, your goal should be actually having the experience of being in these trades and then banking profit. You can adjust your stop loss accordingly once you gain more experience and consistency. So even if you had a 30 pip stop, there's still risk to reward to get. It's still powerful to do so. But this is more so showing you the difference between a risk entry where something hasn't really been confirmed yet versus something that has had commitment now. We've had our first impulse, we've got our first correction, and we're taking it on the break as a reduced risk entry. So again, you're going to see that on multiple currency pairs, and these are going to be the ones that are in your watch list, so you can take full advantage of these moves and gain that consistency. So that's dollar CAD. Let's move on to the next position. So next up here we have Euro Pound. So Euro Pound, we was looking for the sell for a while. Why? Because of the bigger double top formation here. Now, one thing that we actually used here, which is just a very, very quick lesson, is the recent price action. So notice how before, if you look at this bit of price, what happened? We actually just break above very quickly. So we break above the double top in the form of a channel, and we look for more downside. What have we done exactly the same here? Now, not on as high as degree, but we just break above here. But we was also looking for the sell here. What do? Double top, looking for a triple top. We break just above and we break back down. So again, this is more so in the math psychology part, which I'll go into more detail in part 3 of this episode. But looking at it from this structural point of view, as you can see, let's take the larger double top again. So we're looking for the entry type here. So on the 1 hour chart, if we take a look at this structure, there's a few entries that we could get. So looking at it here with a very clear ascending channel, just breaks the high. And right at the top here, we really want to be on the ball, as we said. So going to even the 15-minute chart, which we won't go too in depth with, but just to show you clearly how, if you had price going through here and you just took it as the 1, 2, 3 trend line, like we've learned, you've got to evolve with the structure and you see it for what it is. So then going back to the 1 hour chart and seeing the structure, you can see that yes, it doesn't technically touch the third as 1, 2, 3 here, but you could argue you could have the trend line in here. But the obvious point of point 1, point 2, it's got 3 sections to it, which we can see. So risk entry, how would we take that? Well, you can see the entry type here is what we have is something called the retrace candle, which again, in quick tips, we have a whole episode on this, of the entry types of retrace candles and more specific things, but this is the general overview so you understand the difference between a risk entry and a reduced risk, because we can get more in depth and you're going to learn that along the way. So looking at it here, this is where we would have the risk entry. You're looking at about 25 pips and then targeting 90% rule of this as a minimum and then much more downside. So we're looking at this at either nearly a 9-to-1 or slightly tighter for around 12 to 12.5%, 15. We don't go lower than 15 pips. Again, that's something you'll learn more about. So looking at it there, you can see that we've got the risk entry, and just before we drop, let's remove the ray line because you can see what that is now. Just before we drop, we actually have another opportunity, which you would learn more so on the 15-minute chart for this one, but we just moved sideways with a little correction. So it's giving you another opportunity that, right, we're just moving sideways, almost a very small flag before we push lower as well. There's a good indication that we get there. So that's £1 for the risk entry. And then after we break out of the structure, let's just rein this in so you can see the structure clearly. What do we get? Our first real solid flag. Now, as you can see here, the tight correction, how would you take that? Would we look for a risk entry? Ask yourself now, if you're new and so far from what you've been shown, would you look for a risk entry here, or would you look for a reduced risk? I'm sure you're thinking about a reduced risk, right? Because you can see the tight correction, tight flag. It's the first real flag. And then we're looking at around a 20 pip stop. Reduced risk, you've got your order set just a couple of pips below the trend of the pattern. And then you're targeting the 90% rule. Again, another 7%, etc. that you probably would have walked away with on this one, with about 5-ish%. But again, you'll learn more about on the management side of things of how you can hold trades for longer term or take trades more shorter term. But as you can see, 2 entries there, and there's going to be entries along the way. Even when we zoom out, you'll start to see the very obvious, bigger, larger corrections that start to form, and you'll learn more and more about those. But quite simply, risk entry, reduced risk, and just to reiterate, there's always multiple entries along the way, and you'll start to get more and more comfortable with the entry types that you take. Not all of them are going to be picture perfect, which is why we show the ones that are not, completely perfect, like the one at the top there where it just moves sideways on the 1 hour. They're not always going to be glamorous, but it's where are we within the structure? Are we in a high value area to take full advantage of this trade? If we do, that's where we utilize our initiative a little bit and read between the lines. So that's your account. Let's take a look at a few others. So now moving on to another entry type, looking at another reduced risk entry. So here we have euro dollar on the daily chart, and we can see a couple of things here. So we have our oval, 1 touch, 2 touch, and then we have touch 1, touch 2. So we can see we have this parallel channel here. Now within it, we're looking for buying opportunities and selling opportunities because there are 2 ways to capitalize. So when we see this overall structure here, we can see we've got a descending structure, yes, but for this to break out and push to the upside, we need something to happen on this degree here. So we're going to be looking for continuation. So essentially, if we take price back to here, for this to commit to itself, what you would likely see is a push out, and then on a lower time frame, you would see a continuation pattern to confirm, and then a push to the upside. But what happens? Let's take a look. So if we go to the 1 hour chart, actually have a look at this, a really important lesson. So when we're looking at trades like this, we know that we're looking for a buy setup, but we also can't ignore that there are short-term sell setups as well to take advantage of the trade back to the outer structure. So as this pushes up a little bit more, we can see that it's very corrective on the way up, and we can start to kind of track this in the form of a channel. Let's just play this. It's this part here. So you see how we suddenly get that volatility. This is where it can put people off, because if we just take this bit of price and we look at it, ask yourself 80-20 in a correction. So you know there's a correction. If 80% of it is low momentum corrective candles in that sense, then it's a correction. One impulse doesn't change that. What is this? This is just a bit of volatility with news. And what happens here, let's actually zoom in so we can see. We can see that, typically speaking, when you have an impulse out, what we would be looking for if we was looking for a buy setup is more of a condensed bull flag, which is what you've learned in the episode. We'd be looking for continuation to either look for a risk entry within the pattern or a reduced risk taking on the break. But what happens instead is that it pushes up and it retraces. And this is what we see within structures when we get people caught on the wrong side of the market. So what you'll see is a sudden push up, And the clue is when the market retraces that and then forms a flag like this. So rather than pushing up and forming continuation as a bull flag to push higher, we push up and then push back down and then form a bear flag to go lower. This catches people a lot, so if you don't know this, you won't be aware of it. So in Falcon, as you can see, as we go sideways, you can see, what have we actually done there? We've actually pushed up, but we've moved sideways. So we've pushed up, retraced, and then started the flag, as you can see here. So we have 6 to 8 hours. We're looking for this move to the downside as a reduced risk entry. So taking it on the break of the pattern. Let's just remove this and speed this up just a little bit. So as you can see, we've got our trend line in here, and we've got our 6 to 8 hours. And again, the reason why we're showing you these is because they're not picture perfect and you need to know how to deal with them. So let's say, for example, you've either got on a reduced risk entry on this one, 30 pip stop, or 35 worst case scenario just above the high, and then that play. So you triggered in after a couple of hours, you're triggered into the trade, and then as we play out a little bit further, you can see we start to form another flag. So here we go, it's just on here. So we had another entry on the break. So this one's slightly steeper. It's not your super steep flag, but as you can see, we've got our first entry, which this is where it would catch people on the wrong side. But this is where we will be on the ball to see, right, are we breaking to create a continuation to go higher, or are we retracing to come back down and test the low again? So that's where we're on the ball to figure that out. So we get our first reduced risk entry, and then we get our second reduced risk entry. So let's just remove this palm. So we've got 2 entries on the way down, and the way that we would take that, after you've got that confirmed second point for your trend line, you would take that on the break, set your entry, you'll be looking at about 25 pip stop, and then targeting this for around 7 to 8%. So as you can see, quite simply, the lesson here is in the fact that if 80% of it is corrective, it's still a correction, and one impulse candle will not put us off. That's just volatility, but it doesn't change the structure. It's what happens after is what is key. If we broke out and formed a bull flag, then of course we'll be looking for upside. But the fact that we retraced, formed a bear flag, then pushed down another bear flag, and as you can see, just from here, reining in the trend line like so, you can see very clearly impulse down, correction, continuation. So just giving you a little bit more of a slightly more advanced variation of how it actually looks in the markets rather than just pure picture perfect setups, and you can see how they play out to the downside. So it's just being aware of both sides and not being fixated on a bias, in that sense that if you were so focused on this has to go to the upside, which is where the ego gets involved, or you're more neutral to say, well, it doesn't matter if it's going up or going down, I can make money either way. What happens after the impulse is key. So just bringing it back to here, you imagine that we did break out like this, and then we formed a tight flag. What would we be looking at? Well, then that would be a different story. We'd be looking at this as continuation, like so, as a bull flag, and we would be looking at an entry like so to the upside. We'll be targeting the upside. So you can see how, if you didn't know how to look at it in this perspective, you may have actually been caught in the buy or looking to get long just because you saw that one impulse candle, forgetting 80-20 and forgetting the bigger picture. So a really, really important lesson there. I hope that helps. That is euro dollar. Let's take a look at Aussie dollar. So here we have Aussie dollar. Let's take a look at a couple of entries here. So it's important to look at multi-time frame analysis and understand why we're looking at the particular entry type. So what can we see when we look left? Always important to look left. We can see that we've got this big wick. So we're looking at this as the low and looking for this to continue to the downside. And in this section, let's play this back to around this area here. So as you can see, what we have is more of this expanding type formation here, and we would be targeting this low. So we can see we've got this expanding type structure. We have the lower low within the pattern, and it's slightly creating the higher high, or at least the double top, to then push to the downside. So there's a few variations that we can look at there. So what would we have looked at with our entry firstly? Well, we would have our A line in with the double top, and you can see how we're being squeezed within this. So you're taking it on the break of this structure, like so. which is technically more of a reduced risk because you're taking it on the breakout rather than inside the structure. So if we take it on the break here, you've been triggered in, we'd be looking at about a 35 pip stop and targeting this low as a minimum. So if we just play this, we move back down, and then we get the break even. So this one you would have walked away with, well, let's see, yeah, this likely you wouldn't have lost money, you wouldn't have made money, right? But overall, you can see why we took the trade. But every trade that you take isn't always going to be perfect, that's going to be the one. So now we remove this and we get a bit of an angle. We can see the structure here just starting to play out at the top. Now let's play this very slowly. Now you can see that we would adjust this to this angle because we've broken back down. And what have we started to form, as you can see there? And this is on the 4 hour, bearing in mind. Now let's go to the 1 hour chart. So on the 1 hour chart, you can see that we've got our reduced risk entry here, like so. And just putting this back on so you can see the overall structure. So you can see we're still within the expanding structure and we're expecting this to move to the downside. But what we have here is we have our original entry. After we break the double top, it pushes down, pushes back up, gives us a break even. We then have another risk entry, but we'll focus on this one first. So we do have an entry up here, but looking at this one first, 20 pip stop, impulse down. As you can see, bear flag, very simple in that sense. That's what we would look at. So you can see how even though we push up, we still retrace and form the flag that we're looking at. Would I look for a risk entry in this or a reduced risk? I think you know the answer. We'd be looking for a reduced risk. Why? Because it's more of a tighter flag. You set it on the break, probably a 20, 22, 23 pip stop just above the highs, just most relevant. And then we'll be looking for this to the downside, 2.3, and then at 8.7 risk to reward to the downside there. So as we push down, as you can see on this one, triggered into the trade, very typical with a reduced risk style entry. And then we move to the downside, and then of course we'll teach you more about the management of how you can deal with these positions. But overall, you can see you get your first original entry, breaks down, you take a break even, pushes up, and then going to this other entry, which is risk entry, as you can see on the break there. So essentially we create slightly more of an ascending structure. And again, I wouldn't expect if you're a beginner to be getting involved in these positions. What I would push you more towards is wait for the first commitment rather than just getting into every trade. You'll save yourself from taking lots and lots of losses that don't really need to be in your plan, where you're better off waiting for a first commitment, first flag. As you can see, this one you would have ended up probably getting out around this sort of area and banking a fairly decent amount of profit, and then you can grow with that consistency rather than try to get into these difficult trades. But it's important that we acknowledge them so you know as well. So essentially risk entry within here, or take it on the break of the pattern, but the safest way, wait for the first impulse, take the flag, 6 to 8 1 hour candles minimum. As you can see, more often than not, they actually last a lot more than 6 to 8, but that's the minimum amount of time that we want to wait for. And you got to think about it. If you're working 9 to 5, whatever it is, there's no excuses. You can set your orders. You don't need to be by the screen. That is the great thing about the style, that it has that flexibility. You can set your entry, let it do its thing, and then you manage accordingly, which you're going to learn more about. But that is Aussie dollar, more of an expanding type structure that we wanted to show you. So I hope that helps. Now let's move on to the last, slightly more advanced structure on CAD Yen. Right, so now let's take a look at the last example with CAD Yen, and we're looking at the high time frame, looking at this overall bigger structure. So we have a break of this corrective structure, we push down, and then we're looking for a big correction as continuation to push lower. But it's one thing picking direction, and it's another thing looking at the entry point. So let's take a look at what we have here. So we would have this trend line in like so, and we'd be tracking this in the sense that we can clearly see that this is some sort of larger correction. So where would we be looking for entry? Well, it wouldn't be unusual to have the double top here to see if we reject to go lower. So if we go to the 4 hour and we go to around this area, how would we get more of an indication that where is the trend line of the channel? Well, what you can do is you can right click on this and you can clone it. So you get the same sort of angle, and as you can see, quite parallel. We do trade a lot of these kind of parallel channels. You can see it's not to the T, but you wouldn't have known that the trend line is here until we got a rejection. But the first point we'd be looking at is the double top to see if there's any kind of structure. There was actually a trade within here that would have resulted in a break even in the end. But it's the kind of mass psychology that we're looking at, in the sense that it's very typical to break above where people would think is a resistance, create a slightly larger structure, and then drop in the direction, which is where the Falcon strategy comes in. So let's go to the 1 hour and take a look at that. At what point would you have known to put on that trend line to have that accuracy? Or what can we see? Would we have had it here? No, because we're just moving. We could form a flag and push higher. But it's after we push down and then push back up. That is the key. So tracking it in the sense of this, if we just go back to here, if you're looking at the structure there, we've had a push down, and we can almost confirm that that's a flag to push lower, right? So that is a point where we can be ambitious and put the trend line in, because we've actually had a rejection at this stage. And then we can be forecasting and thinking, well, why the push lower, keep forming continuation, or what we actually do is come back up for the double top within the pattern. We may come back down, stop here and move higher, but we can still take these trades, because at this point you'll be in a bit of profit, you'll take a message from the market, but we also have to look at, we do have a very large gap and a scoop here. So this is creating more of a double top structure to drop to the downside. So let's just play this out a little bit. So now we're at the double top area. This is perfect for risk entry, but we need a rejection first. Here we go. So then we have our first entry, looking at a risk entry at the top of the structure. And we'd be looking at about a 30 pip stop. Give it a tiny bit of room to breathe. You're right at the top of the structure. This is where you don't want to be too lenient, but you want to give it a tiny bit of room to breathe, in the sense that just in case we're spiking, essentially. But let's say we're looking at the target now. We can ignore the ray line because that's already broken through. We are targeting this structure. And then it's also good to recognize, if we use this tool, which you've configured in your trading view, and always take price and have a look at it and actually study it. What does that look like to you? Does this look like an ascending structure that could come to the downside? We think so. So by looking at that, it gives you a bit of clarity. So now we're in the trade. Let's play this. So we drop down. There's a few entries in here. So we've got our first risk entry, and let's move that out of the way. And what do we have here? We actually now have a reduced risk. So when looking at the structure, 6 to 8 hour candles, do we have that? Yes, we do. So we can place our entry just above the high. So looking at around 29, 30 pips, targeting the same thing. Just move that out of the way ever so slightly. So it takes a couple of hours, and you're in the trade, and then we start to form another entry, which you can see here. This one would have been slightly harder to get, as it was very, very fast in that sense with a risk entry. So the only way you would have taken the second one is on a reduced risk at more so about 50 pips. But you have to weigh up the risk to reward. If it's worth it, well, there's still a 7 to 8, nearly 8%. So then it's worth taking. So the entry is still there, but we prefer, remember, the tight flag has the highest probability of the first flag. So we have the risk entry, the reduced risk, and this is a reduced risk entry as well. Now let's play that as well. As you can see, forming another start of a correction, like so, tight flag. Now remember, if something falls from a correction into a correction, it means it's falling correctively, which it can sometimes create a larger correction or drop. So you have to be on the ball with your management, which you'll learn more about. So we have our other entry, which is on the break. This one more about 35 pips, and then targeting to the downside. So as you can see, as we're building down there, we've already had risk entry, reduce risk, reduce risk, reduce risk. And when you learn more about the 15-minute charts, you become more advanced. You'll even learn how to time these even on the 15-minute chart for more accuracy once you understand the key components of the strategy. But let's push this a little bit further. So as you can see, we're forming now a bigger flag. So we've got tight flag, slightly larger, tightish flag, now larger correction. As we're moving down, forming the larger correction, and then we drop from here. So we would have got into this trade in the top area like so of this pattern. So you'll be taking it on the break. So we had another entry on the break here. We will stop just above, and this is essentially a bit of both. It's a reduced risk in the sense that you're taking it on the break of the channel, but it's a risk entry in the sense that you're trading it within this pattern here. So you're still trading it within the flag, right? But you're not getting in right at the top you're getting in on the break of an inner channel in that sense. But you can see the bigger picture, but it's just a tiny detail to mention so you know what that means. As we play out a little bit further, we then start to form more continuation. So again, another expanding type flag, as you can see. So we draw that on. We've now got this continuation, and on the lower degree we have our entries. So a bigger flag at this stage, and then we move up, especially in these areas here. So now we get a much larger expanding before we drop. So you can see very early on in the move what happens there. Much easier entries versus more complex corrections. What happens from a psychological standpoint is that people see all of this happen and then they start entering here. So they're always in the most difficult part of any strategy or price action. This is where the fear of missing out comes in. So why don't they get these entries? It's because they're not forecasting, they're not planning, they're not looking ahead enough in the market, where what we're doing is that we're already anticipating these entries after the break of here. So we're already looking for this to push above ever so slightly. We never know exactly how high it's going to go. That's why we take a message from the market and we get the double top. We push down, we start to form our entries. As you can see, 1, 2, 3, 4, 5, 6. There's probably 10 to 15 entries on the way down, which goes to show you that it's not about looking at multiple pairs, but in the sense that you can take multiple entries on one pair in an impulsive leg. And you only need one impulsive leg to make the majority of your year. On 2 or 3 different pairs, we get some impulsive moves and there's multiple entries along the way. Why is that important? We reduce the fear of missing out. It shouldn't even exist in the Falcon strategy because of so many entries. So if you're someone that's dealt with fear of missing out in the past, you'll find that it's almost non-existent once you understand these entries. And what that does is it helps you not to force it. So then naturally, why would you want to call the tops or bottoms of things when you know once an impulsive leg goes, there's 5, 6, maybe even 10 to 12 entries. Now you're never going to get every single one of them, right? But even if you get 50%, even 30% of the entries, you're going to make some huge percentage points and be further and closer towards that goal of consistency and sustaining that, not just for the long term, but at scale as well. You can scale with this, which is the most important thing, doing what you're doing now so you can do it on much larger capital, which is the ultimate goal. So I hope that helps with the entry types and that's been made clear. So we've got essentially reduced risk and we've got the risk entries, but it's just about identifying when to use them, looking at the high time frame structure and just combining that multi-time frame analysis. And again, this is going to get easier and easier, so it's important that you really do practice. Those that put in the work are the ones that succeed. So as you can see with the entry types, this is how simple we keep it. It's just about understanding where they are and why we use them. And again, you're going to find this a lot easier and easier as you work your way through on a weekly basis. Now let's take a look at stops and targets. So stops and targets. A stop loss is a tool in which that we're capping our downside when you place a trade. You have the position to place a stop loss on that position. The stop allows you to be taken out of the position when the market moves against the trade and reaches that price. Whatever price level your stop loss has been placed is where you'll be taken out of the trade if the price reverses. We use them to lock in profit through a management, and they're adjusted during the duration of the trade to lock in more profit. So it's a way that you can build on that, trail your profit, and then lock that on as price moves in the outlined direction that you forecasted. They are a key aspect of trading, and consistent risk model and staying safe within the markets is one of the most important things. There's been horror stories of people trading without a stop loss, but we can never know what can truly happen within the market, so we need to have those stops in place. So stops and targets. A profit target, if we look at more at the target side, is an outlined area in which that you set an order with the broker to be taken out of the position at a designated price. The broker then will execute that order and they'll close the position down for you at whatever level it is that's indicated by yourself where it's set. Now, some people like to do this if they're going to sleep or they're going to be on a flight or they're not going to be able to manage a trade. They may set a profit target in a certain area. It's not very popular within Falcon. It's not something that I personally do or the coaches do or even experienced students do. But in certain situations, it can be very, very useful. Targets can be for when you're not able to essentially be present on the charts like I outlined. Utilizing when traveling is something that I always do when I'm on a flight. It's one of the most beneficial things, especially if it's a long flight as well. If you're in a running position, you can't manage that trade. So setting a profit target in a particular area that you're happy with based off of the structure is a good way to do that. Another situation is where you could utilize a profit target is overnight when you're asleep, outlining the price that you forecasted and price to reach being that certain area, and you can be taken out automatically while you're sleeping. So another reason, as if it's just a short-term trade, you may be targeting a double bottom or targeting a double top, then it's a great way that you can utilize that. The risk to reward tool within TradingView, it will help you to visualize what all of this means, and it will give you a visual understanding of how the upside is exponential and the downside is consistently capped at 1%, which is the most important thing. Now let's take a look at an example of a stop loss and a target utilizing the risk to reward tool so you can see visually what that means. So now let's take a look at stops and targets and what does that mean. So essentially we're looking at our stop losses and where do we target? Do we actually set targets? We actually are not a fan of setting so much profit targets in that sense. We prefer to utilize the structure and use that to guide us, so then we don't hold ourselves back by closing trades down short when really we have much more to go by looking at the bigger structure. But I want to give you another example of stops and targets. It's not about having the tightest stop loss, and what we have here is CAD yen. Let's take a look at a recent position as how someone who stayed in the trade would behave and someone who's slightly more aggressive that's just trying to focus on the outcome of the percentage. So let's say we have CAD yen here and we have this double top formation and we have this ascending squeeze to the upside. So we're looking for sell setups as we showed you in the entry types. So when looking at it here, we've got a reduced risk entry. After this push down, we have the flag, we're looking for the sell. So what people can do is, rather than setting their entry too close to here, you would set it here for safer. You'd have a couple of pips. But what some people do is they set it really, really close, almost 1 pip away. And instead of having this breathe a little bit, they want to get the tightest stop loss. So they end up adjusting this first and looking at, well, to the beginning of this correction, I would like to make, I'll be happy with 8%, or I'd happy with 9%. And they might try and squeeze it a little bit further. They go sometimes below 15 pips, which you don't need to do. And then what happens? They get tagged in by the spread. Here, sometimes you can be tagged in. You get pushed up, and then you're taken out by a tiny little spike. And then this move plays out, and then you don't get none of it because you've taken not only a 1% loss, but your analysis was right. You was probably patient leading all the way up to it. So you're applying patience here, but then impatience on the entry. It's not congruent. So what is the best way to do that? Well, you set a couple of pips below, you give it a little bit of room to breathe above the correction, which I've highlighted. So 20, 22 pips is fine. You can see it's relevant. It's all about, you don't put your stop loss based off of what you want. You do it as to what is relevant. This is relevant now. Why? Because we can identify the top of the correction with the flag, and we can see that our stop loss is just above. You could argue you could even go 23 pips, it's fine. But having it just really tight just to get the tightest stop loss isn't going to make you consistent. More often than not, you're tagged in and tagged out, and it actually goes in the direction that you expect. Most traders would be consistent if they just altered their stop loss a little bit. So from a stop perspective, that's how we utilize it, and very simple stuff. Again, with targets, you can set targets all day long, but again, if you had a target, let's say to here, because you had some random structure that you thought that was relevant, you set a 2 to 1, and it goes on for longer, and some of these go on to make 10-15%. And then a lot of traders would be consistent if they just didn't close their trades down too early. A lot of you are actually great technical traders. You learn, but you close trades down here, and you risk 1% and then you make 1%. You do 1 to 1, and you're not letting things play out or utilizing something that actually has an edge as a minimum of 3 to 1 and a much larger. So you can see how, don't adjust your stop loss. Don't just half your stop loss just based off what you want to make. And don't set these imaginary profit targets when you can learn how to utilize structure and squeeze much more of the trade. Even going back to the previous example, a lot of people would have set profit targets around here, and you wouldn't have utilized all of this move where we already covered there's nearly 10 entries on the way down. So it just goes to show you, stop loss, very simple. Use the risk reward tool. You have your short position and long position, it's the same thing. But remember, never go in with a thought process of already setting your target before you've even looked at your entry. You almost, I want to make 10% because of X amount, this will make me this much money. And then you're almost forcing an outcome that can't be forced. Focus on the process and more relevant to the structure. So that is stops and targets. Let's move on to the next part, which is scaling in. So as you can see, guys and girls, very, very simple with the stops and targets, and hopefully you understand how you can utilize those, especially targets. It's not very popular, but you can see how you can use them in certain situations. Now let's take a look at scaling in. This is one of the most powerful things that you can learn. So what is scaling in? Scaling in is a major component to what is different within the Falcon strategy opposed to a lot of other Forex strategies. In Falcon, we understand market behavior and sentiment. So we're able to outline areas during price movement to enter a second or a third time. This allows us to capitalize on the full potential of the trade, and it makes some amazing returns when they're executed properly. This takes a little bit of time to learn, but once you get it, it's very, very powerful. Scaling in is a more advanced addition to your skill set. However, it's very, very important for you to be aware that when you're able to capitalize on multiple trades, this is really what accelerates the returns. And again, it's not something that you need to know straight away, but we can build on this, and you're going to learn this as you grow as a Falcon trader. We mention it here in the Foundation series for reference, but it's a topic that we cover in depth further in the Falcon content on a weekly basis. And you're going to learn how you're going to scale in to the markets. Remember, when you learn to scale, your mindset has to scale before your account scales first. So working on your mindset to make that congruent is going to be an amazing thing. So now let's look at scaling in. So firstly, just to reiterate the fact that when we're scaling in, we're not risking more, we're just building on our already position. And what that means is we're adding another 1% to the trade. So here we have CAD Yen. Let's take a look at what that would look like if we was to scale into the move. Now it's important to understand that we're not utilizing the scale in to make more percentage. That's not what it's about. The scaling as a side effect may do that, but that shouldn't be our focus. But if we're taking advantage of a move, let's say as a big impulsive leg to push to the low, then we want to capitalize as much as possible and scale in rather than just searching for other pairs when we can build on one that we already have. Let's take a look at the entry type. So if we go to the 1 hour chart and we look at the entries on the way down, what would it look like if we were to scale in? So let's say, for example, we have our first risk entry with the double top. So we can see at the top here. So we have our double top scale in. And let's say, again, these are not going to be exactly to the T, but we're going to do just an overview of what a scaling would look like. So it may be 30, maybe 25. It depends at the time of your accuracy. And we're targeting, firstly, let's just target the trend. That makes sense for now. So we're targeting the trend line like so. As our target, we're looking at about 16, nearly 17%. And that's our first entry. Let's move it to the side. Then we have our second entry, which is the reduced risk. So we have our flag like so. So if we take the reduced risk at a couple of pips below, stop just above, we're looking at, let's say 29 to, let's call it 30 pips, be conservative. 30 pip stop, more than enough room to breathe, same target. So we've scaled in, it's an extra 14-15%. And let's just move that to the side a second. Then we have two entries here. So we have this entry here, which is a reduced risk, and we have another reduced risk. Let's say, for example, because you're not going to capitalize on each one, that we didn't get the first one. Let's move on to the slightly more obvious tighter flag. And we get another reduced risk on this one, and we're looking at around, say, 35 pips for this. And as you can see there, around 10.5%. Just move that away for a second so you can see. And then just move these, and then looking at the next one, the most likely one that we'll get is this slightly larger flag, and taking this within the pattern, so like this, and we're getting in with one more entry. So we've ignored that one there, but there is another entry there, as you can see, and we're taking this with slightly tighter because it's relevant, right? Because we're able to precisely get in there. It's more than enough above, so 20 pips. So what's interesting there is that you can see this one here, 10.45. This one is nearly 15%, but it's lower down. Why? Because it's more precise. So it goes to show you that it doesn't matter where you're in on the trade, that you don't need to force it. You don't need to get every entry. But as you can see, just from the top, we've got nearly 17%, and we've got 15%. So we're already looking at over 30% at this stage. And then this one, 40% in total, and then 55 on average. Let's say for all these scale-ins, there's about 55%. Would you have banked the whole 55%? Probably not. You would have, the reality when you learn more about management, you would have got out around these sort of areas. So you'd be looking more so. If you're holding it for the longer term approach, which we teach, which you can learn as well, that's a different story. But let's say on the more conservative side, you got out in these areas. You've still got pretty much 4, another 4.5, and you've got another 7.5, nearly 9. You can see how you're still building. You know, you're way over 20% at this stage, building on that on just a few positions. That's ignoring the other one there. So again, this is playing the more conservative approach and more conservative on the stop loss. If you're tighter in on those, then that's going to increase even more. So you can see that by understanding how to scale into the market, all scaling is just building on your current position and risking 1%. It's really that simple. But remember, when you scale into the market, you make sure that your original trade is at break even. That's the key thing. So you haven't got these all open for exposure. If they all turned around, you then, let's say you was in 4 trades, you took a 4% loss because 4 1% losses. That's not what it's about. It's about taking that trade as you push down, you move to break even. So essentially risk is off the table as you take your next trade. And the same goes for the next position. Risk is off the table for this one as you take this trade, and then so on. So you see how that all builds on each other. So when you understand how to scale in, it's absolutely huge for your development. And then you'll see that you only need 1 or 2, 3 impulsive legs throughout the year to make a lot of percentage points. So understand how to scale into the market. It will take you time, but focus on the impulsive legs because that is where they have the highest probability of playing out. If you focus on corrective conditions, it's going to be slightly larger. But if we wait and we're patient, impulsive legs, as you can see, 4, 5, 6. And I mean, we haven't even gone into the 15-minute chart yet. And you can already see the difference in percentage points that you can gain to your overall consistency. So again, scaling in is an art that will happen once you grasp the strategy. But once you understand these key components, you'll start to find that you start to scale into the positions. And that is where you really start to increase your overall performance. As you can see, guys and girls, the power of scaling in once you truly grasp it, it is literally insane. It's not about taking, you know, lots of different currency pairs. It's about understanding when we're in an impulsive move, if we can scale into the market, that is how we build and that is how we compound some insane returns once you know how to do it properly. Now let's move on to the next part, which is watch lists. So what are watch lists? Why are they important? Well, essentially, a watch list is essentially a short list of currency pairs that you've identified, and these are the best and the most probable trading opportunities at the start of each week that we create. As traders, we will analyze several currency pairs and we'll check for the best opportunities to capitalize on. Once we've completed that analysis, we then filter those best opportunities for the week ahead. A weekly watch list is generally doesn't have to be a minimum or a maximum number of pairs to watch. However, in Falcon, we typically separate our list into top 6 and our wildcards for the week ahead. This really gives us a tailored focus as to what's going to happen. Each week, these are broken down in detail in the Sunday market breakdown, which again is where you're really going to grow as a trader on a weekly basis, is understanding that mentorship, seeing how we're moving things in the market in real time. And that is where you truly grow. But guys and girls, let's take a look at how we can look at our watch list, how we build those on the charts. So now moving on to watch list, it's really important that you understand the best way to approach this. So here you can see I have my top 6. So this is my weekly watch list, and we always have the DXY in the front, which you'll learn on the weekly content as to why and how we utilize that. So we have the DXY and then we have the top 6. These are my top 6 pairs for the week. Now, it's important that you have a tailored watch list and you're not just flicking through lots of different pairs, because that really gives you a lack of focus. You have to have this tailored list that you have. Now, at the beginning stages, you might be wondering, how do I create my top 6? What pairs do I have? Well, great news is on the weekly content, it's important that you do your analysis before, but you can compare it to my watch list. So it's okay to follow along at the earlier stages, and it's okay to have the same pairs. And as you grow, you become more independent. You may have a few different pairs, but a lot of times we're singing off the same hymn sheet. So essentially we're looking at similar currency pairs anyway, but you might have a few different variations on a few other pairs as well. So quite simply, this is my top 6, but let me show you a few other things and how you can create your own. So essentially on your trading view, all you need to do is click create new list, and let's call this one top 6 pairs. So top 6 pairs, save. You've now got your watch list, and then you can start adding them in. So for example, let's say you wanted to add in Euro Yen. So you literally just type EURJPY, and then you can see here, you just click it and you've got it in the list. Now, what we also have is something called wildcards. So wildcards is where we have a few pairs that may not be ready right now, but they could be ready in a couple of days, almost like a backup. And that's there to give us more variation of setups. And then what you want to do is that, let's just fill this out. Let's say, for example, we do pound dollar, we add into our list, we have pound Aussie into our list, and we have a couple more euro pairs. Let's say, for example, you've got euro pound in there as well, and then we have USD JPY, so USD yen, and we'll have a CAD pair, so USD CAD. So let's say, for example, we've got these in our watch list. So 1, 2, 3, 4, 5, 6. So we've got our top 6, and this has been filtered throughout the week. Now we want some wildcards. So what you can actually do is, if you actually type in here wildcards and click enter, it actually appears there. So this is just a bit of separation. So let's say in your wildcards you had an extra 2 pairs that you were looking at, and one of them was pound yen, so GBP JPY. We enter, as you can see, it just appears there, and you had euro New Zealand. Let's put that there. So now you can see you've got your structured list, in the sense that you've got your top 6 and you've got your wildcards there. You can flick through them. You're not then going and going over multiple pairs, seeing what's happening there, seeing what's happening here, and getting confused. And that's what people do, and they end up missing pairs in the first place. But if you can just go through these and you've got your tailored watch list, you're going to find that so much easier. So that is the best way to do it. Have it all planned, and the level of clarity you'll have with your watch list once you've got this here will just keep you focused for the week ahead. Then you can forecast, you know exactly what pairs you're going to take, and that will just add so much more precision and enjoyment and accuracy for your week ahead as a trader, so you can be as efficient as possible. But that is the watch list side of things. Keep that simple, guys and girls, and I'll see you in the next clip. As you can see, we keep our watch list very, very simple. And the best feeling in the world as a trader is knowing you've got that tailored watch list going into the week ahead. You're not focusing on all the noise. You just know, right, these are the best possible opportunities. You've filtered them out. You've got a clear mind, clear head, and you're able to execute and be patient and wait for the high quality setups. It is an incredible feeling, and we'll perform this on a consistent basis. Now I want to move on to the last part on episode 3, part 2, which is teachability. This is very, very important because you're learning a lot of strategy-based stuff, and it's important that you have an open mind. Bringing this episode to a close, it's really, really important that we touch on the topic of teachability. Understanding, and asking that question, how teachable are you? How open are you to learning new information? By understanding how our subconscious works, we can refine how we absorb new information, watching through the content multiple times and gaining that clarity with the new information, utilizing things like the 3-step process. This episode can be a lot to take in, especially if you're a new member, which is why we understand how important it is that you watch through this content multiple times over and over again and utilizing the 3-step process. Being teachable is essentially being open. You have to be open-minded, and your willingness to change needs to be stronger than your willingness to just learn. You will consistently build on your understanding over the course and through our weekly content. Right, guys and girls, I wanted to go into something a little bit more detailed with being teachable. I think being teachable, being coachable, this is so important, not just in trading, but your life in general, because it's so key to understand that when you're open, and we talk about things like removing the ego, right? We say this for a very good reason, because when you remove your ego, this is how you remain open. This is how you actually stay up to date with the markets. Otherwise, people kind of get stuck in their ways. They think, well, this is how I've traded from 11 years ago, so I have to trade exactly the same way. But the market evolves, and we always have to evolve. And remember, remaining teachable is our willingness to change needs to be stronger than our willingness to learn. It's very easy to learn. People can watch content all day long. But if you're not creating the right habits, you're not doing the right things that's actually going to set you up for success. For example, learning about doing your forecasting routine in the morning, but then you don't get up early enough to actually do that before you go to work if you're trading around a 9-to-5 job. Again, your willingness to change needs to be stronger than your willingness to just learn. It's easy to just read lots of books but then not apply it. So it's not about knowledge that's power, it's knowledge applied is power. So what I really want you to take away at this point, because you've probably absorbed a lot of information about the strategy at this stage, and It's really, really key in this process that you do remain open and teachable throughout, not just through the foundation series, but ongoing. The best traders and the most successful people that I've personally had the privilege to surround myself with have all had this unique quality. The really, really successful switched on people, they always remain teachable.
Created with free version for non-commercial use.